The previous noise to signal column talked about India's bad loan crisis in its banking system. It showed how independent private sector credit and equity analysts were equally culpable of bad judgment in this crisis. The next question then was, how come India's private sector banks emerged unscathed from this crisis relative to government-owned public sector banks? It is true that bad loans measured as gross non-performing assets (NPAs) of banks is much better for private sector banks than for public sector banks. For the fiscal year 2015, PSU banks' NPAs is 3 times worse than public sector banks. The stock market values private sector banks at twice the valuation than public sector banks. NPAs of private sector banks and public sector banks cannot be compared. It's like comparing small oranges with big watermelons. We studied 6 PSU banks and 7 private sector banks between the years 2009 and 15, when the entire build-up to the current loan crisis took place. These 13 banks combined account for 2/3 of India's banking system. Indian corporates borrowed nearly $2 trillion from these 13 banks in this time frame. 1.5 trillion of the 2 trillion came from public sector banks, or 75% of corporate loan requirements were met by public sector banks and a mere 25% by private sector banks. It is true that private sector banks are smaller in size compared to PSU banks, and their balance sheets are not as large so that they can lend as much to corporates. But guess what? Even relative to their sizes, adjusting for their sizes of their balance sheet, private sector banks do not indulge in as much corporate lending as public sector banks do. Let's say each bank has a choice of a loan to make to a corporate or to a consumer. Public sector banks on average lend 700 rupees to corporates for every 100 rupees to consumer that they lend from their books. Private sector banks, regardless of the size of their balance sheets, lend on average rupees 150 to corporates for every 100 rupees to consumers. So even adjusting for the different sizes of balance sheets of private sector banks, it is clear that they prefer to lend to consumers and not corporates. Why is this the case? Going by India's history, there is twice the chance that a loan to a corporate will go bad versus a loan to a consumer. Loans to corporates typically carry the business risk of the projects for which the money has been lent, whereas a loan to a consumer is backed by regular income stream and collateral such as land or jewelry. So on the whole, private sector bank NPAs are lower than public sector banks because they lend much lesser to risky corporates and they get to pick and choose the corporates that they lend to. Let's then ask the question, would private sector banks NPAs continue to be as low had they indulged in similar levels of lending to corporates vis-a-vis consumers as the PSU banks do? For example, ICICI Bank's reported gross NPA for fiscal year 2015 is 3.8%. If ICICI Bank had lent as much to corporates as PSU banks did, this NPA could perhaps have jumped to 6.4%, same as Punjab National Bank's gross NPA for fiscal year 2015. Had State Bank of India adopted the same ratio of corporate to consumer loans as HDFC Bank did in the years 2009 to 2015, there would have been $500 billion less for Indian corporates to borrow. Perhaps SBI's NPAs today could have been much better, but would India still have built the airports and the roads and the power plants that it did without alternative ways to raise this $500 billion? This is not to imply that PSU banks are efficient or follow impeccable corporate governance standards. Sure, there could be cases of crony lending. Sure, PSU banks are inefficient. But before we blindly advocate that PSU banks follow similar lending norms as private sector banks do for efficiency reasons, we have to think carefully about the impact on the larger economy that this can have. As the popular Chinese saying goes, one does not cut their feet to fit into shoes.